Good morning, everybody. This is Eureka John, and you are at Eureka Street Crypto Hub. It is 6:24 in the morning, and I'm broadcasting live on float.app. And that is a new, uncensorable, decentralized social media platform. Not quite totally decentralized yet, but they're working on it, and it's Bitcoin capable. And it's kind of a great hybrid between Twitter and Facebook and stuff like that. But you won't be seeing them censor you on this platform. Anyway, I was broadcasting on Theta.tv, and I was having some streaming issues, and I will figure those out. But in the meantime, I'm enjoying my time broadcasting on Float.app. So yeah, check it out. Float.app/Eureka John is my page. Anyway, this is my video blog. That's all it is. Nothing more, nothing less. This is not financial advice, and I'm not trying to teach you anything or be educational or anything like that. This is just my documentation of me going through the crypto space and publicly learning and making mistakes and having eureka moments, and then also having extremely cringeworthy moments, all in in one channel. So yeah. So take it as it is, and take it with a grain of salt and whatever. I'd love some feedback, maybe thumbs up, or just tell me some things that you like or things that you don't like that I'm doing, and ways that I can improve. I've learned a lot from the audience, and since last October 24th, 2020, I would say that the quality of the show has gotten better, and my knowledge in the crypto space has gotten better, and that's what the show is about. It's about my journey through the crypto space. So anyway, that being said, let's go take a look and see where the market is today. Yesterday, I did see the Bitcoin get up to $51,000, and it's still there. Look at that, because I hadn't refreshed this screen since yesterday. At night times, I'll lay in bed and I'll sit there on my phone, and I'll be reading through articles and stuff like that. And I'll have CoinGecko up on my phone, and I usually, it's probably not healthy, but I sit there and I read, and I'll read white papers and stuff at night. That's what I read to bed, and the phone will eventually fall on my face. My wife will be sitting there, she's like, "Babe, put up the phone." Well, she's on her phone too, but yes, marriage life, right? Anyway, so $51,484.83 is the price for Bitcoin. Ethereum is $3,407. So that's also doing very well, up 25.6% and up 21.7% respectively. Tether's back up in third place, kicking Cardano out of third place. Cardano is at $2.15. Tether's a stable coin, so it's always pegged to the dollar. I'm going to try to talk a little bit about these stable coins today. I've really been trying to focus in and hone in on stable coins. The next few days, I'm going to be going through various non-pegged stable coins and trying to wrap my head around these concepts. So this is where I am right now in my crypto journey, trying to figure out these concepts of stable coins and these non-pegged stable coins and how fit into the big picture. So you're with me on this journey. Binance coin 424.03, XRP $1.04, Solana 154.90. Everything's up for the past 7 days. It's hard not to be up because of how low we were. Dogecoin 25 cents. USDC is the stable coin, and the ninth place. Polkadot 29.96. Then you have Terra and Avalanche following closely behind. 42.37 for Terra, $60.56 for Avalanche. Binance USD is $1 because it's a stable coin. Uniswap 24.24, and then Chainlink 25.75. Yesterday it got up to about 27 something. And Shiba Inu, what's up with this? Up 75.3% in the past 24 hours. I've actually been seeing that stuff. I don't know, man. I don't know. It's a meme coin. I don't think it has any use case, but some neighbor a while back, I guess last 4th of July or somewhere around there, was all talking about crypto, and he's talking about his investment in Shiba Inu, and I was just like, oh man, you're into crypto, right? Yeah, you know Shiba Inu? I'm like, yes, I've heard of Shiba Inu. It's not really my thing, man. But that's okay. That's your deal, Oh man, I try to put my time and my study efforts, my money into things that I think are going to progress Web 3.0 as a whole. Because that's a dollar cost average. I'm not sitting here looking at these prices trying to trade the markets. And I believe that Web 3.0 as a technology is where internet was back in the early and mid 1990s. And there's a lot of distractions out there. And Dogecoin, I think, is one of those distractions. Shiba Inu is also another distraction. Yeah, so anyway, whatever. And then let's go down here to, I want to see where Theta is real quick. So Theta Network's at $6.31, up 34.7%. Okay, and Monero is at 272, up 19%. All right, so okay, and then I want to see where Quant is. Quant got up to $300 and something, and now it's at 294.51. Quant is weird. It kind of moves. I've noticed, and I don't have hard facts to say this, but it seems to kind of move a little bit inverse to the market. Okay, anyway, all that being said, I've been focusing on stable coins, and yesterday I talked about, let's see, what did I talk about? I talked about private banks versus central banks, and I talked about stable coins. Okay, why private banks, not central banks, should issue currency, especially in less developed countries. Yeah, uh, and I just talked about the central bank's credibility problem, and then how, in a way, I think that they're trying to push the private banks out. And I never thought that I would be arguing on behalf of the private banks, but I'm not arguing on behalf of like Chase Bank or Bank of America or Citibank. I'm arguing on behalf of your small local bank that is basically being bureaucratized out because of this new $600 an over account mandate for them to have to provide to the IRS all types of audits of anybody with accounts over $600. There is neither the money or the infrastructure to be able to implement those type of efforts and make them available. So and that brings in the whole problem reaction solution where CBDCs have to come in and work directly with the people, which is, I don't think it's a good thing. It eliminates a middleman, sure, but then a middleman that won't advocate on your behalf that will basically give you airdrops for some kind of UBI, but will also surveil your every single move and tell you how much you'll get, when you'll get, how fast you have to spend it, where you can spend it, and everything like that. And it will do so according to your social credit score, I believe. So, yeah. I'm always open to changing my beliefs, with debate and just dialogue. But yeah. Okay, so let's go on to this. Anyway, I did all this because I started researching into the various stable coins and how they are pegged to the dollar and what is happening with the dollar. There was a claim that I thought DAI was a decentralized stablecoin, but DAI is still in a way pegged to the dollar. So then it brought in the whole idea of RAI. They call it a pure decentralized alternative for DeFi, because with all this volatility happening with the dollar, all this money printing and everything like that, and this unpredictability, there has been a lot of debate about, well, where are we going to hedge? Because cryptocurrency is way too volatile. I think hedging in cryptocurrency is a great idea, but then again, I'm biased because I love the whole idea of cryptocurrency. So, and then they say, well, anything pegged to the dollar is basically at the mercy of the dollar, and they're creating all their monetary policies surrounding the dollar. So what would be completely independent? Well, they say here, stablecoin RAI launches a pure decentralized alternative for DeFi. All right, so the RAI stablecoin will attempt to bring stability to DeFi markets with the long-term goal of becoming a stable global reserve asset not tied to any nation's currency. Interesting. So, new Ethereum-backed stablecoin. This is back in February of 2021 when this was written. So, this is a little bit of old news. But new Ethereum-backed stablecoin RAI hopes to be the savior of the DeFi sector by providing a truly decentralized stablecoin alternative. Developed by blockchain startup Reflexer Labs, RAI is not pegged to any fiat currency, and its monetary policy is managed by an on-chain autonomous controller. It's a fork of Maker's DAI. So RAI co-founder Amin Soleimani explained, RAI is an asset backed by only ETH, governance minimized, and programmed to maintain its own price stability without needed to be pegged to an external price reference like the USD. So it's interesting. It's a standalone stablecoin, and it kind of begs the question of, what is a stablecoin really? We've kind of created this idea for ourselves that a stablecoin has to be pegged to something. And in general, it has to be pegged to a dollar. That's not necessarily the case. A stablecoin is just that, a coin that's pretty stable. So Soleimani believes that RAI, which he dubbed a money god, has far greater potential than simply improving the DeFi sector. He says RAI is an asset backed by only by ETH, governance minimized and programmed to maintain its own price stability without needing to be pegged to an external price reference like USD. And he believes that a money god has far greater potential than simply improving the DeFi sector. What does he mean by a money god? Anyway, our aspirations for RAI, however, are more profound. If RAI fulfills its purpose within DeFi and starts to earn global adoption, it could prove to be a viable solution to the Triffin Dilemma and bring credible neutrality to the administration of a stable global reserve asset. So the Triffin Dilemma consists of a potentially contradictory incentives which arise when an asset like the US dollar serves as both as national currency and for international reserves. And I kind of went down a little bit of a rabbit hole as to what the Triffin Dilemma is. Where are we here? Let's go take a look. Triffin Dilemma, or the Triffin Paradox, is the conflict of economic interests that arise between short-term domestic and long-term international objectives for whose currencies serve as global reserve currencies. The dilemma was identified in the 1960s by Belgian economist Robert Triffin, who pointed out that the country whose currency, being the global reserve currency, foreign nations wish to hold, they must be willing to supply the world with an extra supply of its currency to fulfill the world demand for these foreign exchange reserves, leading to a trade deficit. The rise of a national currency such as the US dollar as a global reserve currency leads to tension between its national and global monetary policy. This is reflected in the fundamental imbalances in the balance of payments on the current account, as some goals require an outflow of dollars from the United States while others require an inflow. The Triffin Dilemma is usually cited to articulate the problems with the role of the US dollar as the reserve currency under the Bretton Woods system. So the Bretton Woods system was a monetary management established the rules for commercial and financial relations between the US, Canada, Western European countries, Australia, and Japan after the 1944 Bretton Woods Agreement. John Maynard Keynes had anticipated this difficulty and had advocated the use of a global reserve currency called Bancor. Hence, the Bancor DeFi system was named after this. Currently, IMF's SDR, which are special drawing rights, are the closest thing to the proposed Bancor. But they have not been widely adopted enough to replace the dollars as the global reserve currency. So SDRs are basically money that countries can give back and forth to each other. They're not for you and me, but it's basically some kind of global currency that they've tried to implement, but it's not really being widely used. So in the wake of the financial crisis of 2007 to 2008, the governor of People's Bank of China named the reserve currency status of the US dollar as a contributing factor to global savings and investment imbalances that led to the crisis. As such, the Triffin Dilemma is related to the global savings glut hypothesis because the dollar's reserve currency role exacerbates the U.S. account deficit due to heightened demand for dollars. And I'm not really sure I completely understand all that. I'm still trying to figure all this out and become educated on everything that happened with the Bretton Woods Agreement, about the SDRs, what the IMF's role in all this stuff is. It's a very, very complex topic. The Triffin Dilemma and stuff like that. But it just goes to show that there's a lot of complications when you try to make the dollar as a kind of universal currency. And anything that is pegged to the dollar, which we have a tendency to do in the cryptocurrency world, to have some kind of platform. And I always say stable coins are kind of like the side of the pool, and when you're in the pool, you're playing around as a kid, and the water's all choppy, and you're playing Marco Polo and sharks and minnows and all that stuff. And then suddenly the lifeguard blows the whistle because everything gets too rowdy, or somebody gets hurt, or somebody takes a dump in the pool or something. And then they blow the whistle and they say, adult swim, and it's time for the waters to be calm. Everybody goes to the side of the pool, and that's stable coins. You get out of the market, you go to the side of the pool, you sell what you have, you get your gains, and you go and you sit with your stable coins on the side of the pool for a while you wait for the next opportunity to jump in once everything settles down for a bit, or you see another large a large dip. So yeah, anyway, that's kind of what stablecoins are. But stablecoins have been pegged to the dollar, and with all this stuff and the Triffin Dilemma basically rearing its ugly head right now with everything going on, this is creating problems. So people are looking for other solutions. So the Triffin Dilemma consists of potentially contradictory incentives which arise when an asset like the US dollar serves both as the national currency and for international reserves. So, announced today, the asset RAI has launched on the Ethereum, well, not today, but this is back in February, on the Ethereum blockchain, and is available via Uniswap version 2 with liquidity mining pools, and to be announced in the coming weeks prior to a strong liquidity pool. The team admitted that the controller will be weaker than usual. While it's a stable, it's not pegged to the value of the US dollar, and initially RAI's redemption price will be set at 3.14 pi. One immediate use case in decentralized finance, or DeFi, the team predicts will be a method to avoid liquidation on strong price fluctuations for Ethereum and other cryptocurrencies. So whenever you have something out and you've leveraged your stablecoins and you pulled out a loan and you have collateral, when the value of that collateral drops, a lot of times you are liquidated in order to pay for the drop in value. And or if you have longs out, like I just experienced the past week in perpetuals, I had $200 out on Ethereum, but Ethereum suddenly decided it wanted to drop down to the lowest it's been in a very, very long time, to 27.56. And that my liquidation point was at 27.88. I lost that $200 because I was stupid and decided to try to play the leverage game and try to learn the levers and pulleys of the leverage game for my first time ever, right at a terrible time when Ethereum was going to drop in value. So I got liquidated. Whatever, it's a learning experience, and I'll chalk it up as educational expense. But yeah, I couldn't be more of a dumb butt, So anyway, but whatever, it's part of what this process and this show is all about. It's about you witnessing publicly my learning process. So maybe you can be like, yeah, I don't want to be like that guy, Anyway, stable coins like Tether are centralized and pegged to the US dollars, while even MakerDAI accepts centralized stablecoin USDC as collateral. So DAI has multi-collateral DAI, when previously it was just single collateral. So they accept USDC as collateral, and they are always marketing that one DAI equals $1. Anyway, this makes true decentralization finance acolytes concerned, as centralized coins can be censored. RAI only uses ETH as collateral, so the only collateral is Ethereum. RAI's ability to maintain a stable price fluctuations in the value of its ETH backing revolves around its PID controller, a control loop mechanism similar to a car's cruise control. The asset has two prices, a redemption price and a market price. And when the market price deviates from the redemption price, an interest rate for those who have staked Ethereum is set to oppose the price move, incentivizing users to return RAI to the target price. So Soleimani explains it works kind of like a spring. They put in here Soleimani, who is also the CEO of the crypto cam site SpankChain. Well, how is that relevant? I don't. Who cares what else? What if he's in part of some adult website? It doesn't matter. But he's talking about RAI stablecoin here, and they just interjected that. It just makes no sense. But anyway, disregard that. Soleimani explained that it works kind of like a spring. The further the market price of RAI moves from the target price, the more powerful the interest rate and the greater the incentive to return RAI to the equilibrium. So it works as kind of a buffer, as a spring. And so you have the price of Ethereum, and if it goes way up here, it kind of the price of RAI acts as a little bit of a spring in between that doesn't allow it to or shock absorbers, right? That doesn't allow it to move too much, but it still stays proportionally valuated to it. So Soleimani added that the redemption price is also known as the target initial price. So Soleimani added that the redemption price, also known as the initial target price, does not really matter because RAI only cares about relative stability. During the testing phase conducted throughout 2020, which used proto-RAI tokens, the asset's price managed to maintain a volatility level of 4% lower with an average price of around $2. During the same period, Ether's price grew by more than 250%. That's Reflexer Labs is the one that is putting out this, and I'll go to the website here. Let's take a look at Reflexer.finance. So why RAI? Let me just go back to the homepage here, and we'll take a look. And I was kind of poking around through the website yesterday, and it's an interesting concept. A decentralized and non-pegged stablecoin that defies fiat currencies. All right. So mint RAI, you can deposit your ETH, mint RAI, and protect your loan from liquidation. And then there's a quick explainer about RAI, and then the protocol statistics. RAI is an ETH-based backed stable asset. You can use it to take out loans against your ETH at a small interest rate, as well as protect your loans against liquidation. Liquidation protection enables greater capital efficiency. So let's go read why RAI. All right. So liquidation protection. RAI allows minters to protect their positions from liquidation with the use of Uniswap liquidity pool tokens. Liquidation protection enables greater capital efficiency and offers a greater guarantee they will keep their funds. Then you can also do self-repaying loans. The RAI interest rate alternates between positive and negative. When the rate is negative, the protocol pays minters either by devaluing RAI or by self-paying everyone's loans. Governance minimized. RAI was designed from the ground up to become governance minimized as time moves on. It is only backed by ETH and mostly managed by code and crypto native. RAI is not directly affected by U.S. Federal Reserve monetary policy at all. It's not even touched it, as opposed to DAI that has an increasing reliance on decentralized assets. RAI is ETH pure and gets stronger with each passing day. I've read the RAI white paper also, and I think it's a good white paper. But before I go on to something like that, we're 23 minutes in. I did want to not completely dog on DAI because I like DAI, and I wanted to I found some myths. Where are you? All right, here we go. Busting market maker DAO myths, 7 misconceptions about DAI. All right. So here, okay. So here's some myths. DAI can be generated using centralized assets. Therefore, it is not decentralized. So right here, here's busting maker DAO myths, 7 misconceptions about DAI. DAI is an algorithmic stablecoin. It's a myth, right? It's also called algo-based coins or seigniorage style coins are not backed by collateral. Instead, they aim to peg the price of a token to its target level using on-chain algorithms that increase or decrease supply or buy and sell tokens according to market conditions. DAI, which is soft pegged to the US dollar, is backed by a diversified portfolio of crypto collateral assets. When multi-collateral DAI was released in November 2019, it brought the Maker protocol and DAI into a new phase, offering a more robust power platform to power a stronger yet more flexible currency. Instead of relying on algorithms to influence supply and demand, DAI relies on Ethereum smart contracts, decentralized price feeds, and the global Maker governance community to maintain its soft peg. DAI, therefore, is best characterized as decentralized collateralized stablecoin. Okay, so myth number 2, DAI can be generated using centralized assets, therefore it is not decentralized. Okay, they say, while it's true that DAI can be generated using centralized tokens such as USDC, USDT, TUSD, and PAX, those collateral assets don't make DAI any less decentralized. To be clear, the opposite is also true. DAI generated from ETH or any other decentralized collateral asset doesn't make the stablecoin any more decentralized. Okay, all right. So they're saying if DAI generated from ETH, which would be RAI, doesn't make the stablecoin any more decentralized. Interesting. So a DAI is decentralized because there's no centralized authority with control over individual tokens. So they're saying the fact that they work on a smart contract protocol makes them decentralized, not and so it doesn't matter whether or not they're pegged to the dollar. Interesting. So users create and have control over their DAI, and the maker protocol is governed by a distributed group of maker holders who cast votes in the voting portal. Moreover, MakerDAO is self-governed by approving a diversified basket of collateral assets. The maker community helps to ensure that no one asset poses a threat to the protocol as a whole. So there is a diversified basket. It's not just dollar-pegged stable coins that they use as collateral. Additionally, a key role of maker governance is to apply to each asset an appropriate risk parameters, including a debt ceiling, liquidation ratio, and stability fee. The MakerDAO risk team provides weekly analysis that permits the DAO to review developments to related collateral assets. Okay. And then here, there's no point in pegging DAI to US dollars since the dollar continually loses value. And that's myth number 4. Traders in crypto and mainstream financial markets sometimes express concern about the devaluation of the US dollar. So the DAI team, MakerDAO, says, while the USD is subject to inflation just like any other currency, it remains the world's reserve currency. As its story, it is one of consistent strength. DAI has gained popularity in Latin America, for example, precisely because the US dollar is stable compared to local currencies subject to high inflation. That said, the DAO may consider creating varieties of DAI in the future. I don't know when this was written, but one of those varieties is RAI now, it seems. And let's see if there's anything else that I really need. Okay, all right. So that's all that for in relation to RAI. So let's go back over here to Reflexer Labs. Let's see. There was one paper I was looking at. Where? All right, here we go. Stability without pegs. This Medium article was pretty fascinating. Over the last few years, the term stablecoin has come to mean peg coin, an instrument that in the long run has a value closely linked to a specific asset or basket of assets. Okay, so that's what stablecoin has come to mean. Like I said earlier, it's come to mean a pegged coin, and that's not necessarily what stablecoins are. Recent market dynamics showed that the pegged coin narrative poses a problem for collateralized stablecoin projects. Let me just highlight that. Namely, it limits the economic incentives a system can use in order to influence a stablecoin's market price. One of those incentives being negative interest rates applied to all coin holders. If the system were to have built-in rates, the stablecoin would depeg, and thus the initial pegged narrative would be broken. Okay, that's pretty interesting stuff right there. A notable example of a stablecoin which currently struggles to maintain its peg is MakerDAO's DAI. During Black Thursday, DAI's price soared more than 10% above its intended $1 USD peg. As a response, governance token maker holders had to bring both the stability fee and the savings rate close to zero. Even with these drastic measures, DAI is still trading above the peg to this day. And you can see that when I'll go to CoinGecko in a little while, and you can see that it's like $1.02, $1.01, stuff like that. Even with these drastic measures, DAI is still trading above the peg to this day. Many in the Ethereum community asked why DAI's rates cannot go negative so that governance can exert even more pressure on the market. The simplest answer is that the 1 DAI equals 1 US dollar meme has to be kept alive at all costs, and so that the system is not designed to support negative interest rates. Okay, so at least not the current system in its initial design, as described in the purple paper. DAI did have negative rates. More importantly, though, the design showed that DAI's market price is not supposed to always come back to the same redemption price of US dollar. Rather, the redemption price itself is meant to float. To put it bluntly, a stablecoin was defined as a low volatility asset. That's it, compared to its own collateral. And then so it's a low volatility asset whose redemption price and rates are determined by the market, not by decentralized governance. All right, so the market should be the determiner, where DAI is saying, well, if there's any issues, then the governance, the decentralized governance, will come in and take control of it. That's not really the point. It's supposed to be corrected by the market itself. So the original motivation for having a floating redemption price anticipated Black Thursday scenarios. If the system were designed as per the original specification, it would have reacted more decisively to nullify the significant market price surge. Sadly, the sound mechanism design was abandoned until now. So enter these reflex indexes. So Reflex.finance, Reflexer.finance, which creates RAI. All right. And the purpose of the reflex index is to be a more stable representation of its collateral while still maintaining a high level of trustlessness. If used in other protocols, a reflex index can shield its users against major and sudden moves in the cryptocurrency markets. For example, if Maker had used reflex indexes as a collateral prior to Black Thursday, vault creators would have had more time to avoid complete liquidation. So a lot of ETH, remove volatility, and protocol eats reflex index of ETH. I like the little Pac-Man figure. Uh, Before we go through a couple of examples to see how reflex indexes react to market change, let's review the terms you'll encounter. So reflex index is a collateralized non-pegged asset with low volatility compared to its own collateral. The redemption price is the price the system wants the reflex index to have, always stuck at 1 USD for DAI, but variable for reflex indexes. And the market price is the price that the market values the reflex index at, and then the redemption rate is a per second rate, which can be positive or negative, used to incentivize users to generate lever more or pay back their debt. The redemption rate usually gradually changes the redemption price, similar but not identical to an interest rate. And then borrowing power, how many reflex indexes can be borrowed against 1 unit of collateral. Then they give a little graph. I'm going to link this so you can see some of the details. I don't have time to go through this entire paper, but it shows all these scenarios, and basically, like I was saying, RAI acts as kind of a shock absorber, to correct some of the volatility that has been happening, especially with Ethereum lately. And I believe with EIP 1559 going into place, and then the merge to ETH 2.0, Ethereum is going to be going very, very high. I'll be interested to see how all this affects this. And I'm still not completely understanding all this. So this is what I'm trying to do. But anyway, how can a protocol use reflex indexes? So a protocol, like a DeFi protocol, for instance. So after launching the system, anyone will be able to atomically deposit Ethereum to create reflex indexes, and then deposit reflex indexed ETH in another protocol to borrow or create other crypto assets, as well as synthetic gold, oil, stocks, or even the current prevailing synthetic USD. The indexes act as middleware between the initial crypto asset and the final protocol. The main benefit of using the indexes as collateral is that they dampen some of the volatility from the assets supporting them. So anyway, in summary, DAI is framed as a pegged asset, meaning that it must maintain its market price close to a single non-moving value. Regardless, its initial goal was different and more akin to a reflex index. And then reflex index are dampening machines with this property. With this property, a reflex index can actually be used as a collateral for a pegged coin, because this way the pegged coin would have a dampened exposure to crypto assets such as Ethereum if ETH is using creating the index. So anyway, I heard yesterday on some podcast somebody was talking about the value of the peso versus the U.S. dollar, and people always look at just the peso as being the volatile one, and because the guy grew up in Mexico, and then seeing the peso, it costs so much more pesos to equal a dollar, to buy something, but they never take into account the bottom denominator of the U.S. dollar, and because the U.S. dollar is changing as well. So when you have something pegged to something that you previously deemed as stable, U.S. dollar, but then you realize, wait, the U.S. dollar is not really that stable. What do you do? And so this is kind of their solution for that. Anyway, I've gone on 36 minutes. This has been a long one, and I haven't even really gotten into some of the things that you can do in Reflexer Labs and Reflexer.finance, because they do have some pretty cool products that are in conjunction with Uniswap, or in conjunction with Aave, and some other type of and other DeFi products. There's a lot going on in Reflexer Labs. I'll link this in the description. Maybe tomorrow I will try to talk a little bit about some of the more practical things in Reflexer Labs and Reflexer.finance. I'm sorry, in order to try to benefit from RAI, but I wanted to get some of these fundamental concepts out of the way first before I went on to that. So yeah. That being said, yeah, I gotta get about my day, and yeah, I'm just kind of navigating through all this stuff, taking it as I go, and if I don't explain it in a way that is completely understandable, please forgive me. I'm trying to understand all this stuff myself, but that's the point of the show. All right. Well, that being said, you guys have a good day, and hit me up, give me one of those likes and thumbs up or not, and I will talk to you